China continues to turn the regulatory screws on its internet sector. This time, Beijing has issued draft rules banning unfair competition in the internet sector and dictating how critical data should be handled. Now, this is the latest move in a crackdown on its powerful tech companies. Platform operators will not be allowed to use data, algorithms, or other technical means to influence users' choice. They also can't prevent access to other legal internet products and services. China's cabinet said it would also implement regulations that protect critical information infrastructure from September. Authorities have imposed various restrictions and punishments on the tech giants for anti-competitive behaviors over the past few months. Shares of China's tech firms listed in Hong Kong took another drubbing on the news. Bilibili led the way down south, closing over 7% lower. For more, we're joined by Nirgunan Tiruchelvam. He is head of consumer sector research at analytics firm Tellimer. Well, Mr. Tiruchelvam, algorithms are a key way for internet companies to generate targeted ads. Will the draft rules deal a blow to the sector?
Well, you need to look at the attack on algorithms or the regulation of algorithms within the context of the very light regulations that the tech companies in China have operated under for the last 20 years. And it's a case where these measures and the measures that were taken over the last month are measures taken by the government for the regulatory regime to come into step with what the situation is in a number of other countries. So basically, it's a case of regulatory catch-up, and investors should not be swayed by these developments.
So if the bans do go through, though, how would the companies then have to generate growth and profit?
These companies have a very sound business model. To put this into perspective, Tencent controls WeChat, which is a super app. It's a great messaging service, and it has almost 1 billion users. Similarly, Alibaba operates one of the largest e-commerce platforms in the world. It actually saw very strong GMV growth in 2020, in the year of the pandemic. The business fundamentals are very strong because both companies, Alibaba and Tencent, are looking to operate as super apps. They control a vast array of people's activities, from e-commerce to insurance to messaging to gaming and even food delivery. Hence, it's very difficult for their fundamentals to be dislodged by this development.
So you're saying that that's not really going to affect the valuations of the sector then?
There would be a recalibration of the risk perspectives of the sector. There is no doubt that investing in emerging market tech stocks, especially in China, is fraught with risk. You have regulatory risk, you have governance risks, you have execution risks, and this development is just an indication of what the risks are in this business. There would be a recalibration of people's understanding of the risks, but the fundamentals are very sound, and we suggest that investors use this opportunity to accumulate more positions in the EM and China internet sectors.
So, Mr. Tiruchelvam, you're saying should investors then avoid Chinese tech altogether or not?
They should use this as an opportunity to accumulate more China tech names. This is a golden opportunity for investors to buy a dip at a time where internet usage is surging in China. This is a great opportunity as long as you are aware that there are going to be ups and downs as the trajectory moves upwards.
Well, thank you so much, Nirgunan Tiruchelvam at Tellimer.